So one of the most important parts of buying real estate is understanding your financial options. And today we're sitting down with someone who helps buyers navigate that every day. Today I'm joined by Rafael Torres, a mortgage loan originator with Golden Bridge Capital. So when should someone start talking to a lender if they think they might want to buy in the next year?
The earlier, the better. Before you go see homes, you should know what you can afford.
A lot of people here pre-qualified and pre-approved used interchangeably. What's the difference and why does that matter?
If you're pre-qualified, it just means you had a conversation. That's all it is. It means you called a lender, you spoke to a lender. You told them, I'm W-2, I make $100,000 a year, this is what it is. And they go, you can get a home for this much, right? A pre-approval means that I did my job to the fullest extent. It means that I reviewed your bank statements. I reviewed your income. I asked for your pay stubs. I went through all the measures to make sure that no matter what happens, we are closing this deal. You are not going to lose this home.
Yeah.
And I did my job. So pre-approval and a pre-qualification, night and day difference.
Yeah. Not every buyer fits into the traditional W-2 box. What options exist for those self-employed borrowers, investors, or clients with unique situations?
So we can use your bank statements, we can use profit and loss statements. We could even use the property itself. So if you're buying it as an investor or you're buying it in another way, we can use a DSCR. So it changes the underwriting from the borrower to the building. So instead of me asking for your documentation, I'm just using the building. The building performs well, the building has a certain ratio, even if it's down to zero where the building makes no money, it just breaks even. I can fund the deal as long as the building performs in some way. You don't need to be a clear-cut borrower that makes a salary, works a 9 to 5. If you're a business owner, if you're an investor, there's still options for you to own homes.
So how does interest rates impact a buyer's budget and purchasing power in practical terms?
If you're at a 5.5% rate, let's say your mortgage is $1,500 a month, right? That's incredibly low, but let's say $1,500 a month. At a 6.5% interest rate, that could be $2,400 or $2,500. And now where that fits into your DTI and your allowed housing expense now has been reduced. So because the allowed housing expense has been reduced and the rate is higher, that brings your buying power down, because now it's like, instead of a $600,000 home at a 5.5% rate, I might be only able to qualify for a $500,000 home at a 6.5% rate.
Yeah.
So it then begins to limit your options simply because the percentage of interest you're paying has gone up a full point.
Yeah.
That's the biggest difference. That's actually the biggest effect that interest rate can have on your credit.
Do you ever encourage people to wait until rates come down, or?
No, and I don't want to sound like a cliche mortgage guy where it's like you have to marry the house and date the rate, whatever. It's simply just, if you can afford to do it, do it. Rates and property value are never on the same page. They're constantly in like a seesaw battle. So if you love the home, buy the home now. And then eventually, when you're in a spot where people are competing and fighting because rates are lower, you already own the home. Now you can refi into a lower rate. You're in a good position. You may even have more equity because now everyone's buying everything on the market. So now you can take that equity. You might even be able to lower your loan to value, reduce PMI, eliminate PMI. If you can afford it, buy it.
Yeah.
That's my advice.